All right, let's dive into a problem that, trips up countless small businesses and is a classic question for any accounting student. What do you actually do when the books are a total mess? We're going to break down exactly how to handle incomplete financial records, moving from the theory right into a practical, step-by-step solution. So, this is the big question, right? How in the world do you figure out if a business is making any money when its books are messy and you don't have a perfect, clean set of accounts? That's the puzzle we're going to solve today, and it's a super important one. Getting this right is absolutely essential for everything from filing taxes to applying for a loan. So, to really get a handle on this, let's picture a little local grocery shop. The owner, they're great at tracking the basics: cash coming in, cash going out, and who owes the money. But you can see there are no formal sales accounts, no purchase accounts, no real expense tracking. This is a classic textbook case of incomplete records. And this method actually has a name. What our little grocery shop is using is called the single entry system. The big thing to remember here is that it doesn't follow that golden rule of accounting you're probably used to, equal debits and credits for every single transaction. And that's exactly why we call it a system of incomplete records. Okay, so to really get what we're working with, we first need to lay a really clear foundation. Let's compare this single entry system to the gold standard, the double entry system. Understanding the difference here is going to be crucial. And this slide just lays it all out, doesn't it? On the left, you've got the double entry system. It's complete, it's accurate, and it's the standard for any larger business. But over on the right, you have the single entry system. Yeah, it's simpler, but it's incomplete. And that means it's impossible to directly prepare something like a profit and loss account. This is the world we're operating in today. Now, you might be asking yourself, why would anyone even use an incomplete system? And, the answer really just comes down to practicality. For a small business owner who's juggling a million things, maintaining a full-blown double-entry system takes a ton of time and specialized knowledge. The single-entry system, even though it's not perfect, is just, it's more manageable for the day-to-day grind. But just because it's manageable doesn't mean it's complete. So if we can't prepare the normal financial statements, what do we do? Well, that brings us to the tools in our accounting toolkit. The very first method we're going to master is called the Statement of Affairs method. Here's a fantastic way to think about this. Imagine you're a personal trainer. To see if your client made any progress, you'd weigh them at the start of the month and then again at the end, right? We're doing the exact same thing, but for the business's finances. We are literally measuring its financial weight at two different points to see how it's changed. So formally, this is known as the Statement of Affairs, or sometimes the net worth method. And the definition is just like our analogy. You figure out the profit by comparing the business's capital at the beginning of the year to its capital at the end. That difference, after a couple of little adjustments, is your profit or loss. Simple as that. This whole method really just boils down to a simple three-step process. Step 1, you calculate the opening capital. That's just your assets minus your liabilities right at the start of the period. Step 2, you do the exact same calculation, but for the end of the period, to find your closing capital. And finally, step 3 is the crucial adjustment. You add back any money the owner took out, we call that drawings, and you subtract any new cash they put in. That final number you're left with, that's your true profit or loss. Okay, but what if just comparing the net worth isn't really enough? What if you need more detail for the bank, or maybe to file more complex taxes? Well, that brings us to the second tool in our toolkit, the conversion method. Oh, I love this analogy. The conversion method is pure accounting detective work. Seriously, you're given a case, but there are missing pieces of information. Your job is to use the clues you do have, like cash records and customer balances, to reconstruct the full financial story. And the formal definition is exactly that. It's the whole process of taking those incomplete single-entry records and piece by piece converting them into a complete double-entry system. The goal here is to fill in all those blanks so you can prepare the whole shebang, a full trading and profit and loss account, and a proper balance sheet. So, what are we actually hunting for in our detective work? Well, the main culprits, the big missing pieces, are usually the total credit sales and the total credit purchases. And we find them by creating some key ledger accounts, like a total debtors account to figure out sales, and a total creditors account to figure out purchases. Okay, check this out. This slide shows you exactly how this detective work happens in practice. We're rebuilding a total debtors account. We know three things. Customers owed us $5,000 at the start, we got $20,000 in cash from them, and now they owe us $7,000 at the end. So we just work backwards.
Think about it. If they ended up owing $7,000 after paying us 20, that means the total debt must have been $27,000 at some point. Since they started by owing $5,000, the missing figure, the new credit sales, has to be $22,000. It's a really simple but powerful bit of reconstruction.
Okay, wow. We have covered a lot of ground. So let's pull all of this together into some core study notes. If you're gearing up for an exam, this next slide is the one you're going to want to screenshot. So here are the absolute key takeaways. First, single entry is an incomplete system, super common in small businesses, and it mostly just tracks cash and personal accounts. Second, to find the profit, you've got two main tools. You have the statement of affairs method, which is quick. It just compares your net worth at the start and end of a period. And then you have the conversion method, which is way more detailed and involves playing detective to reconstruct the missing data and create a full set of accounts. And I want to leave you with a final question to chew on. We've looked at two very different methods for solving the exact same problem. Which one do you think gives a more accurate, a more true picture of a business's profit? And maybe more importantly, why? What are the trade-offs? It's something to think about.